Bitcoin's fear just hit its lowest level in history, lower than the Terra collapse, lower than the FTX meltdown, lower than the COVID crash. The Fear and Greed Index just printed a 5. And while retail investors are panic selling, billions of dollars in short bets are building. Funding rates have flipped deeply negative, and BlackRock's ETF just saw record volume during the drop. So here's the real question. Is Bitcoin about to crash even harder? Or are we witnessing the exact same setup that marked every major bottom in the last 5 years? Because historically, when fear reaches this level, something big happens next. Stay with us, because the data right now is telling a very different story than the headlines. Tonight's top story. Bitcoin's Fear and Greed Index has dropped to a historic reading of 5, the lowest level ever recorded. Lower than the panic during the FTX collapse, lower than the Terra crash, lower than the COVID crash. And according to crypto analyst Lark Davis, this may not be a signal of deeper collapse. It may be the signal of a bottom. In this report, we break down why extreme fear historically marks major reversals, the billions in short bets building pressure in the system, what funding rates are quietly telling us, why BlackRock's ETF volume matters, how Bitcoin's weekly chart resembles the June 2022 bottom, why altcoin dominance just triggered a major signal, and why AI tokens are flashing a rare divergence. Let's begin. Extreme fear, a historical bottom signal. The Bitcoin Fear and Greed Index has hit a score of 5. This reading is unprecedented. For perspective, during the Terra collapse in 2022, the index bottomed near 8. During the FTX bankruptcy, it hovered around 10. During the COVID crash in 2020, it briefly dipped near 12. Today's reading is even more extreme. Markets are psychological machines. When fear becomes universal, it often signals capitulation, the moment when sellers exhaust themselves. Historically, Bitcoin has formed major bottoms during periods of maximum pessimism. In March 2020, Bitcoin fell below $4,000. Fear dominated headlines. Within 12 months, price rose above $60,000. In June 2022, Bitcoin traded near $17,600. The sentiment was overwhelmingly negative. Within the following year, Bitcoin reclaimed $30,000 and beyond. Extreme fear does not guarantee an immediate reversal, but it often marks exhaustion in selling pressure. And that is where we stand today. Billions in short bets, fuel for a squeeze. While retail sentiment is deeply negative, derivatives markets are revealing something important. Billions of dollars in short positions have accumulated across major exchanges. When traders heavily bet against price, they create potential fuel for a reversal. Here's how it works. A short seller borrows Bitcoin and sells it, expecting to buy it back lower. If price instead moves higher, they are forced to repurchase, creating buying pressure. This is called a short squeeze. According to Lark Davis, when retail traders pile aggressively into shorts, market makers rarely allow those trades to play out smoothly. Instead, price often moves in the opposite direction. The S&P 500 put-call ratio recently spiked to its highest level since the Liberation Day crash. That indicates heavy downside hedging across broader markets as well. Historically, such extreme positioning tends to precede counter-trend rallies. The market rarely rewards the majority at emotional extremes. Funding rates turn deeply negative. Another important signal comes from funding rates. Funding rates measure the cost of holding long or short positions in perpetual futures markets. When funding rates turn negative, it means short sellers are paying long holders. Currently, funding rates across major crypto exchanges have dropped into deep negative territory.
The last time funding rates were this negative was August 2024. That period marked a major bottom. In the 4 months that followed, Bitcoin rallied approximately 83%. Negative funding suggests that traders are leaning heavily bearish, and when positioning becomes crowded, markets often reverse. It is not a certainty, but it increases the probability of a squeeze-driven move upward. BlackRock's IBIT ETF volume surge. While retail sentiment is fearful, institutional activity tells a different story. BlackRock's IBIT ETF recorded record trading volume during the sell-off. That detail is critical. When panic spreads among retail investors, institutional participants often step in quietly. Volume spikes during declines can indicate accumulation. It suggests that larger players may be buying while smaller investors are selling. This pattern has repeated multiple times in traditional markets. Whether IBIT flows represent net accumulation or simply elevated trading activity remains to be seen. But record volume during extreme fear is not a trivial development.
Weekly chart resembles June 2022. Now let's examine the technical picture. Bitcoin's weekly MACD has dropped to its lowest level ever recorded. The relative strength index on the weekly time frame is approaching oversold territory. The last time RSI reached similar levels was June 2022. That period marked what many consider the true bear market bottom. Although FTX later pushed price approximately 30% lower, the structural selling pressure had largely peaked. Currently, Bitcoin remains above the 200-week exponential moving average near $68,000. Historically, this level has served as strong long-term support. Lark Davis disclosed entering a long position around $69,000, targeting $74,000 at the 20-day EMA. Whether that target is achieved depends on broader liquidity conditions. But the technical alignment resembles prior bottom structures more than early cycle breakdowns. Altcoin dominance breakout. Beyond Bitcoin, altcoin dominance, excluding BTC, has confirmed a monthly MACD bullish crossover. This is significant. A bullish crossover on the monthly time frame is rare and often precedes multi-month momentum shifts. Davis compared the current structure to 2019-2020 rather than 2022. In 2019, altcoins quietly began building strength before broader retail participation returned. However, caution is warranted. Similar bullish altcoin signals have appeared over the past year without sustained follow-through. Macro conditions remain uncertain. Liquidity cycles matter, but the structure is shifting, and structural shifts often precede narrative changes. AI tokens, search interest versus price collapse. 1/3 of the most searched altcoins on CoinGecko are AI-related. Examples include Tensor, Venice, Virtuals, and Near. Public interest remains high, yet prices continue declining. Virtuals is down 46% in the past 30 days, despite ecosystem revenue growth. This divergence between fundamentals and price suggests a valuation reset. When interest remains elevated but price falls, markets may be repricing risk or creating opportunity. In previous cycles, narrative-driven sectors often experienced sharp shakeouts before strong recoveries. The question now is whether AI tokens are structurally overvalued or temporarily mispriced. Risk factors to consider. While bottom signals are emerging, risks remain. Global liquidity remains sensitive to central bank policy. Equity markets are volatile. Macro data can quickly shift risk appetite. If Bitcoin loses the 200-week EMA decisively, downside risk increases.
If ETF flows reverse sharply, institutional support may weaken. Extreme fear can last longer than expected, but markets rarely remain one-sided indefinitely. What this setup suggests: when we combine historic fear readings, billions in short positioning, deep negative funding rates, institutional ETF volume, weekly oversold conditions, altcoin dominance breakout, AI sector divergence, the picture suggests elevated probability of a counter-trend rally, not guaranteed, but statistically favorable. Markets often bottom when confidence collapses, not when optimism returns. One analyst summarized the situation bluntly: "Lows are in, we are buyers."